Hi, my name is Barry Weber. I'm an attorney and CPA in the Fresno, California area. And the purpose of this short webinar is to discuss the basics about special needs trusts. This video is not intended to be a in-depth coverage of the topic, but only basic concepts, and is not intended to be legal advice or form an attorney-client relationship with you. Now, the purpose of a special needs trust is to provide a better life for a disabled person, which is normally a child, after you die, and do that while protecting the child's SSI and Medi-Cal benefits. Funds can be used for any purpose not paid by SSI and Medi-Cal, and the funds do not interfere with the beneficiary's right to SSI and Medi-Cal. So they're not a counted resource belonging to the beneficiary. But the beneficiary has no control over how the money is spent. That's done by the trustee or custodian. Now, there are types of special needs trusts that can be set up for non-disabled beneficiaries who just can't manage funds, and these are called spendthrift trusts. In this case, the beneficiary never has control over the funds and can't force payments, has no right to spend or pledge the principal or future income of the trust, and the trust distributions are controlled and usually discretionary by the trustee. Simple special needs trusts are non-revocable, but the trust terms can provide for revocation by a trustee under certain circumstances. For example, where government benefits are no longer needed, where the trust funds are depleted or at a low level, where the beneficiary is no longer eligible for government benefits. And when the beneficiary dies, well, first of all, you need to understand that there's two different types of special needs trusts: a first-party special needs trust and a third-party special needs trust. I'll go into this in more depth, but it basically refers to whose money is in the trust: the beneficiaries in the case of a first party, or another person in the case of a third party. When the beneficiary dies, if it's a third-party special needs trust, which is the most common, the balance goes to the named remainder beneficiary in the trust. So there's no loss and there's no Medi-Cal reimbursement under a time. Now, setting up a third-party special needs trust, the trust itself can take effect during the lifetime of the donor. That can be funded with any types of property, but because the whole purpose of a special needs trust is to spend money on the beneficiary, the trustee will probably convert tangible items contributed to the special needs trust to cash. The trust can be funded with minimal assets, and you can add to it while you're alive, but contributions while the donor's alive are subject to gift tax. The donor can be the initial trustee during his lifetime and appoint a successor trustee on death. The balance of the funding of the trust can occur through a will, a living trust, life insurance, etc. And the trust must have its own EIN number, file its own 1041 tax returns, and it's a separate entity. Now, you don't need to use a special needs trust to provide for your disabled child while he's alive. The basic same rules still apply. You can't duplicate Medi-Cal payments without avoiding having those funds being counted towards Medi-Cal. But it's okay to direct gift funds to cover extra needs not covered by Medi-Cal and SSI. But there's no need for a special needs trust. The amount that you give the child directly is still subject to gift taxes and exemptions. You can give a direct gift by inheritance at the donor's death, but the same problem still applies. That money going directly to the beneficiary is counted toward the income and asset limitations of SSI and Medi-Cal, which are quite low. And even if the beneficiary gives the money away, there's a 3-year look back for SSI and a 5-year look back for Medi-Cal, where that money will be clawed back in for Medi-Cal benefit eligibility purposes. Now, there's no need for a special needs trust if you're only receiving Medicare or SSDI, because those programs don't have asset limitations for beneficiaries. But it might make sense if you think that in the future the beneficiary would have a need for Medi-Cal. Now, a first-party special needs trust is funded from the beneficiary's own funds. Now, most commonly, that'll be an injury settlement, an inheritance, or something like that, but it doesn't have to be. The beneficiary must be under 65 years old to fund his own special needs trust, unless he uses a pooled special needs trust. And we'll talk about that in a second. The special needs trust must be for the sole benefit of the beneficiary. And a pooled trust, or what used to be called a community trust, can be used for first-party assets. The assets deposited into a pooled investment account managed by a nonprofit corporation. The remainder of the first-party funds after the beneficiary's death are usually kept by the nonprofit for other beneficiaries. And it can also be used, a pooled trust can also be used for third-party special need trusts, and in that case, the remainder goes to the beneficiary. In first-party special needs trusts, reimbursement to Medi-Cal is always required. So whatever was spent by Medi-Cal during that person's life is going to be recaptured by Medi-Cal from the first part, any funds remaining in the first party special needs trust. And a first party special needs trust has no provision to terminate early. Now, the more common type of special needs trust is the third party special needs trust. Now, these are set up with funds from someone other than the beneficiary. It could be a parent, a grandparent, or anyone. And they can be set up either during the lifetime or at the death of the donor. They can be from unrelated parties. They can be funded by wills, trusts, life insurance, etc. They can be funded from the beneficiary designations for banks, brokerage accounts, retirement accounts. Now, any funds that are provided through a will must go through probate. Funding a special needs trust through a revocable living trust is the most popular method because it avoids probate. And a special needs trust can be set up for a surviving spouse as long as it's established by will, but it can't be set up during lifetime or by a revocable living trust. So what can be paid out of the first third-party special needs trust? Any health care out-of-pocket costs or premiums can be paid. Any expenses that SSI or Medi-Cal won't pay can be paid. Anything that will increase the beneficiary's quality of life, as long as it doesn't duplicate what Medi-Cal or SSI are already paying. It can even pay for shelter, but you're going to reduce SSI benefits. In some cases, that might be worth it because the SSI reduction is currently limited to $256 a month. What you don't want to do is give the beneficiary cash. You want to pay it directly to the provider, because if you give them cash, it's countable as income to the beneficiary and counts and reduces the benefits. Now, there's another option to a special needs trust, and it's called a 529A ABLE account. And ABLE stands for Achieving a Better Life Experience, and it was established in 2014. It's simpler to set up. It's simply a bank account created for a person who was disabled before the age of 26. And disability is defined by the Social Security Administration. Now, it can be set up at any time. It doesn't have to be set up before the age of 26, but the disability had to occur before that age. And any funds that are in the account don't count towards SSI and Medi-Cal limits. The person with the disability can control his own account, and income earned in the account are not subject to income taxes. But there's some limits as to how much you can put into a 529 ABLE account. Total deposits from all sources are limited to the annual gift exclusion, which is $15,000 in 2018. The contributions are after tax, so there's no income tax deduction for contributions like an IRA. And if the beneficiary is receiving SSI, there's a $100,000 limit as to how much can be in an ABLE account. Distributions from an ABLE account can be only used for qualified disability expenses. And those can be health, housing, transportation, education. If you use the money for food, that's considered as in-kind for SSI. And as we discussed before, an ABLE account can be used to pay for housing expenses without limiting SSI. Each state sponsors its own ABLE program, and California is still setting up theirs. It's currently active in other states, and you can set up your ABLE account in another state, but you can only have one ABLE account at a time. When a beneficiary dies, any funds left over in the ABLE account are subject to Medi-Cal reimbursement. So whatever was spent by Medi-Cal during his lifetime is going to be clawed back to Medi-Cal on his death. Excess funds over that amount go to the beneficiary's estate. Now, there's some changes coming down in 2018 to ABLE accounts. The annual contribution limit is now $15,000 because the gift tax exclusion went up to that amount. Savers tax credits. A beneficiary contributions to his own ABLE account may qualify for Savers tax credit up to $2,000. The ABLE Financial Planning Act will allow 529 educational savings account balances for some beneficiaries to be transferred to ABLE accounts. So where there's an existing 529 educational savings account and the person is disabled, any amounts not used can be transferred to an ABLE account. And that's still subject to an annual contribution limit of $15,000. In the works is an Able to Work Act, where an ABLE account owner who works may be eligible to contribute an additional $12,060 to an ABLE account. These are things that are anticipated to happen in 2018, and we'll see where it goes. So in conclusion, if you want more information on this or any other topic, visit my website at www.barryweberlaw.com, send me an email. I'd be happy to schedule an introductory consultation or in person or by phone. Thank you for listening.